Hello and welcome. You're watching The Money Show. I'm with you, Kavita Thapliyal, and this is a show where we help you navigate through all your financial strategies and help you align with all of your financial goals. It's very important that along with earning and spending, you take care of your investments also, because it's these investments that will help you with your financial security and will help you live a financially free life, a financially independent life. This is the show where we help you understand anything and everything about each and every financial instrument that's right for you, and we also do your life financial planning on this show. So just in case you are new to the Money Show and you want our experts help on your investment portfolio, all you have to do is just scan the QR code that's flashing on the screen and you will be connected to a WhatsApp number. Send across your current existing investment details, and if at all you have any financial goal that's aligned with those investments, our experts will help you with the right kind of strategy and will give you their advice and recommendation on your investment portfolio. So this is a financial planning session also on the show that we do. But today, let's talk about your spending. And when we talk about spending, if you are one of the millions of Indians who use a credit card for reward points, cashback, airport lounge access, utility bill payments, or simply to maximize every rupee spent, then the story directly impacts you, because quietly over the last few months, some of India's biggest banks, including HDFC Bank, ICICI, Kotak, Mahindra, Axis and others, have started rewriting the rules of credit card game. That's right. The new rules and changes are applicable from 1st June 2026. Now, the message is very clear. The era of easy rewards is slowly coming to an end. For years, customers got used to earning points on almost everything, whether it was paying electricity bills, school fees, rent, insurance, premiums, or even loading money into digital wallets. Every transaction helped accumulate reward points. But banks are now taking a much harder look at these spends. You may ask why. Because many customers discovered ways to maximize rewards without actually generating profitable spending for banks. Now, in some cases, people were earning huge reward points through transactions that carried very little revenue for the card issuer. As a result, banks are changing the economics of credit cards. So, what exactly is changing? Let's break this down for you. First, rewards are being restricted. The biggest change is around reward points. Several banks are either reducing reward earnings on categories such as rent payments, insurance payments, wallet loads, and government transactions, or putting monthly caps on how many points customers can actually earn. Now, this means that even if you spend the same amount as before, you may receive fewer rewards than you did a year ago. For a premium card user, this is particularly significant because reward points often justified the annual fee. Now, customers need to carefully check whether their spending pattern still qualifies for the same benefits. Also, the second one, bill payments may become more expensive. Now, this is the second major change that's involving bill payments. Many customers have been using credit cards to pay utility bills, mobile bills, broadband charges and insurance premiums because it helped them earn rewards while also managing the cash flow. A very smart financial planning, but what is happening is banks are increasingly now imposing limits, reducing rewards eligibility or introducing charges on certain categories of payments. In simple terms, transactions that were once treated like regular retail spendings are now being separated into special categories with different rules. So, before paying a large insurance premium or a hefty utility bill through your card, it is worth checking whether rewards still apply or not. Now, a very famous way or very famous use of credit cards, airport lounge access. That's right, it's no longer guaranteed. This is a major shift that we are talking about, because for many travelers, complimentary lounge access became one of the most attractive credit card benefits. We have seen credit cards being launched just for this particular benefit, but banks have discovered that usage had surged dramatically. Now, what's the result? The result is many cards now require customers to meet a minimum spending threshold before lounge access is unlocked. So instead of receiving automatic access simply for holding the card, customers may need to spend a certain amount every quarter. Now this will cost you, because for frequent travelers, this is an important change, because showing up at an airport expecting lounge access and discovering you no longer qualify can be an unpleasant surprise. So please be sure that you take a look at it. Also, the other change is high spenders may face new charges. Now, banks are also paying very close attention to certain spending categories that they consider low margin or non-profitable. Transactions such as rent payments, wallet loading, gaming-related payments, and some educational payments have increasingly attracted convenience fees or additional charges. The logic from the bank's perspective is very straightforward. These transactions involve cost for the bank, but they don't generate enough revenue to support a generous reward. So the costs are gradually being passed on to the customers. And one may ask that why are these banks doing this now? This is the question many consumers are also asking. The answer lies in the profitability. Credit card rewards are not free. Every cashback offer, every reward point, every airport lounge visit, and every milestone benefit costs money. As competition intensified, banks offered increasingly attractive benefits to attract customers. But now, the industry is entering a phase where profitability matters more than aggressive customer acquisition. Banks want customers who spend regularly on retail purchases, travel, dining, and shopping, categories that generate healthy interchange income. They are less interested in transactions where customers can earn rewards, but the bank earns very little. So that is why we are seeing a systematic tightening of benefits across the industry. So what should you as a card holder do now? The first step is very simple. Read every communication from your bank. Most people ignore emails, SMS alerts about their card changes, but these messages often contain critical information about revised reward structures, spending thresholds, and the new changes. Second, review your spending habits. If you primarily use your card for insurance premium, or say rent payment or bill payments, or the card that worked for you 3 years ago may no longer be the best option today. So you need to review your spending strategy, align your cards, and see what kind of benefits are still there and what have gone away. And third, don't chase reward points blindly. A common mistake is spending extra money just to earn points. Remember, the best credit card strategy is not about collecting rewards. It's about avoiding interest charges, paying bills on time, and using the card in categories where benefits genuinely exceed cost. So the bottom line over here is credit cards are not becoming less useful, but they are becoming more selective. Banks are rewarding profitable spending and reducing incentives for transactions that don't make economic sense for them. So for consumers, that means one thing: you can no longer assume that yesterday's benefits still exist today. In personal finance, the fine print always matters, and when it comes to credit cards, reading that fine print could save you money, preserve your rewards, and prevent some very unpleasant surprises. So that is something that one should be keeping in mind. But now let's take a short break, and post that we'll be starting your financial planning session. All right, so let's continue and let's get connected with the guest on the show who will be answering all your portfolio related queries. And just in case you want to be a part of this show, or you want to ask any of your questions, you can scan the QR code that's flashing on the screen and you'll be connected with a WhatsApp number. You can send across your questions there. Give us details of your existing investments and also the kind of financial goals you have lined up for yourself. And our experts will help you align all of your investments to your financial goals. But now to answer all your portfolio specific queries, I'm joined by Samisha, our guest on the show today, who will be helping you achieve the financial goals and the life of financial freedom. Samir, hi, good evening and welcome to the show. Let's take the questions, and this is from Himanshu Khanna. He's 37 years old and he's got almost 20 years in his hand, and for that he wants an investment strategy, 1,000 per month in a mutual fund. He wants to invest and he wants to know which is the right kind of fund for him, multi-cap or flexi-cap. He's confused in both of these categories. Okay, so what would you like to advise him? Because I'm not sure about the existing portfolio details that he might have. Although he's saying that he wants to start investing at 37, we don't have any financial goal that he has lined up for himself. How would you like to guide him? He's someone new, maybe, to equity.
Good evening, Kavita ji. Thank you so much for having me on your show today. So first, I would like to highlight one good thing about Himanshu ji is, he's planning to invest for 20 years, which is really good. Now, when we talk about flexi cap and multi cap, I guess Himanshu ji, this is your dilemma. This is not your only dilemma. A lot of investors get confused between whether they should go with multi-cap or flexi-cap, right? So let me explain you what is multi-cap and flexi-cap. So it will make your decision pretty easy. So when we talk about multi-cap, see, multi-cap operates under strict rules. They must multi-cap funds have to keep minimum 25% in each category: large cap, mid cap, and small cap, irrespective of market condition. So here, fund manager has to abide the rule which has been set by SEBI, right? So they cannot, and only 25% which is remaining with them, which they can play looking at the market situation. Whereas with the flexi cap fund, the fund manager has total freedom, right? If market turns volatile, in that situation, they can take exposure to exposure between 72 to 80% into a large cap category stock. So here, fund manager has a very fund manager has a freedom and agility. If he feels market is going turning volatile, in that situation, and he can increase the exposure into large cap. And when they feel this is a good time where they can take the exposure into mid cap and small cap. In that situation, they can increase the exposure. So this is a short summary what is mid cap and multi cap and flexi cap. Now, what should you go with? Right, if you if you don't mind seeing portfolio swing between up and down, right, and you wanted to maximize, not maximize, but if you wanted to generate little more return as compared to flexi cap, in that situation you can definitely choose multi cap. But if you prefer a peace of mind, professionally and dynamically manage, somebody should manage your fund, in that situation you go with the flexi cap. I'm sure, we have very limited information about your risk-taking capacity as well as your existing portfolio. That's why I have suggested both the ways. If you want to play, if you wanted to take some more risk, in that situation, you select multi-cap. Otherwise, go with flexi-cap.
Also, Samir, since we are talking, he is 37 years old. Do you think he has missed a lot of time?
Kavita ji, here, Himanshu ji has clearly mentioned that he wanted to invest for 20 years, right? In that situation, and the amount he is planning to invest is 1,000 rupees. I guess he has plenty of time. He can definitely play, if you can definitely take risk in that situation, he should go with multi-cap fund.
All right, but then going ahead, he will have to strategize his portfolio, Sameer. Just starting off these investments is not enough. He needs to get it right. Although right now he's just confused about these two categories for his investments. But going forward, if he has some financial goals, how would you help him to align those financial goals and move ahead in this path of investments?
So, Kavita ji, looking at the Himanshu Khanna's age, 37, say at this age, like no, generally, if this is the only portfolio, or say we need some more information, what is the like no, how much of his total portfolio or total investment is there in debt fund, and how much exposure he holds in equity, right? This can help us to this can help us to at least do the financial planning properly. But looking at the age, our recommendation should for Himanshu ji is like no 65% of your total investment should be in equity and 35% of your total investment should be in debt. Like that is the basic step to with like no you can start your investment. Second thing, when we are talking about the investment, right, it has to be definitely a goal oriented. So here rather than like no starting amount, like no starting investment with 1000 or 2000 rupees, first define the goal, like no for what purpose you are investing. Second, once you decide that, then how much fund is required, that is this second fund second question which Himanshu ji ask like no he should ask himself. And the third is like no for achieving that goal, how much time he has and what amount of investment he needs to do now. So this is the three-step formula which Himanshu ji should follow. By doing that, like no, he'll get a lot of clarity about why he's doing investment and what amount is required, after what like no, and after what tenure, what amount he will get. So he'll get all the answer clearly. So this is the first thing I believe Himanshu ji should do.
Okay, let's move on, Sameer, and let's take the other question. This is coming in from Mr. Rajiv. He's retired from April 2025, and he's got equity funds worth 1 CR, and pension is almost 40,000, and rental income is close to 60,000. He wants to get 15 to 16% return, and for that he wants you to recommend him a strategy. How much can he get by SWP if he invests 1.5 crores in SWP? How can he get a monthly income that's needed or that's planned by him via SWP, 15 to 16% of it in terms of return? So very interesting question, and a lot of aspects to this question. First, he's retired, although he has his pension. He's got a rental income also, so his regular expenses are taken care of. But now he wants his equity portfolio to grow further with 15 to 16%. So first question, the first part of the question is this kind of a return achievable for someone who's retired? And even if someone wants to take that amount of risk, how can you rationalize that kind of a return? And second is SWP, how much can he get? So for that, we might need more details. But having said that, Sameer, how can you help him out?
So, Kavita ji, first of all, like no, the let's go with the first question. Like no, expecting 15 to 16% return on the investment. So, my first recommendation or my suggestion to Rajiv ji is he like no for expecting 15 to 16% return on investment, it is like no bit too much at this age, because here at this juncture, like no, he'll not be getting a fixed income or maybe the regular source of income. Here, the goal of Rajiv ji should be capital preservation and some bit of growth, which can at least beat the inflation. So we have to change the primary objective of like no, rather than chasing 15-16% return, our recommendation should be at this like no at this stage he should go with the safer, realistic, and stress-free return. So he should rather than chasing 15-16%, he can for retirement corpus, our recommendation should be he should aim 10 between 10 to 12% of a return. And trust me, if he has 1.5 crore and if he is planning for SWP, I'll share a lot of information about that also. But my first advice is, if we are chasing 15-16%, it is very high. Here we have to take aggressive risk with the investment, and your maximum exposure should be there in the equity. So our recommendation, we should not chase that. We should definitely go with the conservative return side between 10 to 12%. Now, your second question is with SWP. So if you invest 1.5 crore rupees, and I will create a two different scenario. First is, suppose if you are withdrawing, you are going with the safe route where you are withdrawing only 6% of the total corpus every year. In this case, 1.5 CR, if we consider 6%, which means every month he can withdraw up to he'll get up to 75,000 rupees, which is really good, as he already holds 1 lakh rupees. He already has a 1 lakh rupees fixed income. Apart from that, if he's getting 75,000, I guess, it will be fair enough for him. This is a very conservative side, and if you want to go with little more practical approach, then he can opt for 7% withdrawal. In this situation, the monthly withdrawal amount would be around 87,500. Now, let's assume, suppose if he is choosing 6% withdrawal every year, in that situation, after this withdrawal will continue for next 25 years in this situation, and if his investment generate around 11% of return, post all withdrawal, he left with around 6.5 crore rupees, which is really good. So our suggestion is this is very practical way to look at the investment post retirement.
All right, Sameer, let's move on to the last question of the day. And this is coming in from Shivam. And so he's 30 years old, and he wants to invest in funds for 20 years. At present, the portfolio value is 9 lakhs, and the details are Kotak Multicap, Parag Parekh Flexi Cap, Motilal Oswal Mid Cap, Bandhan Small Cap, SBI Contra, ICICI Aggressive Hybrid Fund of Fund. And so total SIP is 25,000, and he can invest for more 20 years. He wants to step it up. Do's and don'ts for long-term investing is what he's looking at. So, okay, so congratulations. So you're 30 and quite aware of how you want to go ahead in your investment journey. Sameer, what would you like to advise Shivam, or maybe start with a checkup on his funds mix?
Yeah, Shivam, looking at his age, 30 years, he has picked up he has made a very good portfolio for himself. He has selected best scheme out of it. Only one suggestion here from our side is as he is planning to invest for next 20 years in that situation, and having ICICI aggressive hybrid fund of fund. Here, our suggestion is he should not generally hybrid fund or index or ETF or passively managed fund should be initial years are always a growth year, where investor should look for a higher growth. He can take higher risk, as his age is only 30, he can definitely take little higher risk. Here our suggestion is he should not continue with ICICI aggressive hybrid fund. Instead, that he can transfer, he can replace with either any larger and mid cap fund, or he can divert this fund to flexi cap fund. This will help him to generate little more return than the benchmark. So that is the first thing. Second, his question was how much he will able to accumulate with step up and without step up. Say if he continue his SIP for 20 years, 25,000 SIP for 20 years, along with his currently present accumulated portfolio of 9 lakh rupees. the AUM is about the after 20 years, his AUM will be approximately 3.36 crore, which is really good. And if he do 10% annual step up, in that situation, his portfolio valuation would be around 6 crore 15 lakh. So definitely step up will if he do step up on a regular base, he can he can simply double the AUM.
All right, I think with that, it's a wrap on the show as well. Thank you so much, Samir, for being on the show and helping our viewers understand how to navigate through their portfolio planning going ahead. And for our viewers, I'm going to leave you with our WhatsApp number. There's a QR code that's flashing on the screen.